Okay, folks, welcome to the monthly charts live show. First time we're doing this under this title, Monthly Stock Charts Live. So we only have a couple of trading days left to go in the trading month. So what we want to do is we want to prep for next month. The key is that after such a volatile couple of months, how are we closing? What indications do we have that we're going to see a continuation move up higher next month, or do we move lower? And that's what we're going to take a look at. That really, I call it the 100,000 foot view of the battlefield. Then you drill down to your weekly charts, that's your 10,000 foot view, then your daily charts, 5,000 foot view, et cetera, et cetera. But you need to understand the macros to appreciate what the overriding trend is. Is the trend still up in the equity markets, or has it broken? I think we have a couple of surprises tonight for everyone. So let's get to it. I'm going to say thank you to our friends over at TrendSpider for sponsoring us. As always, more on them later. I did not mean to have this up initially. We're going to talk about the economic data coming out this week. I wanted to do this last night, had a conflict, couldn't do the show. So we're doing it tonight. We're going to talk about the valuations of the equity market. I also want to talk about the Federal Reserve's balance sheet, which is the proximate reason as to why I believe that this market has been so resilient of late. It's because there's an expectation that we're seeing some, here it is, some cessation of hostilities in the, here we go, in the tariff war. And I think that's a little bit premature, to be honest with you. We do have a bill that's going to be going from the House of Representatives to the Senate for negotiation, the one big, beautiful bill that is supposed to be the tax cut bill. I'm not impressed with what I've seen so far, to be honest with you. I voted for Trump. I want him to succeed, but I don't like the tax package. If they show me a tax package without the change in the ceiling for alternative minimum tax, it means nothing to me. So the SALT deductions will matter to California, New Jersey, Connecticut, New York, but overall, I'm not that excited about it, again, from what I've seen thus far. So let's say hello to folks. Franklin, welcome. The lovely Jody, welcome. Okay, for those folks that haven't already done so, head on over to the forum, and I have requested chart requests. We have Sean in here, Talon. So this is still open. If you're not currently in our forum, please do so. I'll drop the link into the forum or the chat box. Get that out there. Takes 2 seconds to join. No credit card required. Okay. So let's begin. Before we go to the monthly charts, let's talk about the economic data that's coming out this week. And there's a lot. Tomorrow, it really gets kicked off with consumer confidence. We're going to see, this should be interesting. The trade balance should now be interesting given the fact that we have tariffs in place. So this has not been an interesting report for about 25 years. So this one may get a little bit of attention. Then on Wednesday, we get ADP employment. Then we get the GDP for Q1. Expectation is for an expansion of 0.4%. Then we get the employment cost index. That is a measure of inflation, wage inflation, consumer spending, big number. More inflation data coming out this week. The PCE index, that is the Federal Reserve's favorite measure of inflation. Then we get ISM manufacturing, auto sales, construction spending, initial jobless claims. We get that every week. That's become more and more important. And of course, on Friday, we get the pimp Mac Daddy of all economic data, that is non-farm payrolls. So a expensive week. Hold on, I got to check this out. I need a pair of these. $9.99. They changed the price if you go large. Wow. All right. I'm a sucker. I'll go to that later. Summer's coming. Got to get ready. Okay. So that's the economic data that is coming out this week. Did I not bring up? Yeah, I did. Okay. Out of sequence here. All right. In terms of earnings this week, not a lot today, but tomorrow in the morning we get SoFi, we get PayPal, UPS, JetBlue, Pfizer, Coca-Cola. Spotify comes out. Then after the bell, we get Visa, Starbucks, One Oak. That's a good company. Before the bell Wednesday, Humana, Caterpillar, Generac, another good company. ADP, GE Healthcare, Hess. After the bell Wednesday, really important day after the bell. We're going to get Mr. Softy, Meta, Qualcomm, Annaly. That's a big dividend payer for you folks out there looking for dividends, and it's been beaten up quite a bit. In fact, I'm going to go over that chart. NLY, the symbol. You should pay attention to PWR as well. That is Quanta. I used to own that company many years ago. And what they do is that's a construction company. So if there's any onshoring of U.S. manufacturing, they're going to benefit. They report before the bell on Thursday. We're going to get Lilly out before the bell, MasterCard, Mickey D's, Shake Shack. Lots of consumer this week. After the bell on Thursday, Amazon, Apple, Airbnb, Reddit. And then on Friday, we get energy stocks, ExxonMobil, Chevron. I can't believe that Exxon's no longer in the Dow. Chevron is. And that's it. That's the week. Let's say hello to folks. Corey, welcome. Mr. Sean, welcome, sir. TZ Burden, welcome. Good to have you, pal. Okay, that's earnings. So we'll go to this in a moment. Let's talk about valuations of the market. Now, I've been a buyer of stocks over the past few weeks. We had sentiment, which was really, really down. And so we bought stocks. We loaded up on Boeing. That's my biggest position right now. The TQQQ, that's the leveraged Qs. We loaded up on that. That's the second largest position. I do have a hedge on that position. I did not add to it today. Given the fact that we rallied into the close, I added slightly more TQQQ. And it's been a good month, a very good month. So the key is let's not lose sight of the valuation of the market. The valuation of the market using a rear view mirror metric, meaning past earnings reports or rear view mirror guidance or PE multiples is 34.23. That's an expensive market where the mean is at 17.23. So still very expensive. We were down to around 31 at our low point this month. Now we're right back up to 34.23. Now, what I find disturbing about this number, and it may change after this week, given the fact you have so many big companies that are reporting, is that with all the big banks that are reported, with all the companies that have already reported, you would think that we might have grown into the multiple somewhat. We really haven't. So, we'll take a look at the forward-looking multiple in a second, but I really like to pay attention to reality, what's been reported, what's the current multiple on the equity market, and an afterthought is forward-looking valuations. A lot of people put a lot of value on that. I'm not dismissing it. It's just not my primary measure of how to value equities at current. I want to know what they've reported. So we're expensive. And I say that as somebody that's net long the market right now. Now, taking a look at forward-looking valuations, the trailing 12-month P, oh, this is a trailing PE. Didn't I have the forward up here? I don't have the forward. No, I think this is a typo. No, it says trailing. That's inaccurate. It's inaccurate. I believe that this would be for the forward-looking multiple, not the trailing. Let's go to FactSet again. This is interesting. SPX is reporting a net profit margin above 12% for the fourth straight quarter for Q1. Analysts expect higher net profit margins for the rest of 2025. I just repost because I don't want to lose this stuff. Let's see if we can get the forward valuation off of FactSet. Here's the forward. I question this number, though. Unless Schiller's applying a different methodology. I'll still go with Schiller. I'll still go with the Buffett indicator, which shows us here. I'm not going to use FactSet's numbers because I like to use the Schiller as well as the Buffett indicator. This is a measure of the valuation of the equity market relative to US GDP. So it remains strongly overvalued. So these two metrics is what I use. While I like FactSet's data, I don't like their trailing metric here. Their forward metric looks on point. The forward 12-month PE ratio for the SPX is 19.8, which is below the 5-year average of 19.9, but above the 10-year average of 18.3. So what this is telling us is that, while sure, the valuation on a forward-looking basis of the equity markets has come in quite a bit, it's not cheap. We haven't hit cheap yet. So, and even fairly valued. Moving on. The S&P 500 year-over-year earnings growth of 10.1% for Q1 is above the estimate of 7.2 on March the 31st. Not that long ago. Let's put things into perspective. They've lowered guidance. You're getting a lot of beats, better forward-looking data. I will admit that the earnings, with exception of Tesla, the earnings for this quarter have been okay. But don't forget, they were reduced. They were lowered. So it was easier to beat expectations. SPX is reporting year-over-year revenue growth of 4.6% for Q1, which is above the estimate of 4.4% reported on March the 31st. So good stuff. We have some good news here. On a forward-looking basis, the equity markets are not frothy. The however is, the trailing certainly still is. Are we out of the woods with this sell-off? No, I don't think we are. The however is that I think that what's going to happen very shortly is that the Federal Reserve is going to get the message, especially if economic data comes in weak. Remember, this is a jobs week. If jobs comes in weak this week, guess what equities are going to do? They're going up. They're going to go up. And the reason is that Wall Street, bad news is good news. Because All they care about is, do we get a rate cut? Now, for May, there's no probability of a rate cut. They're going to be reporting on May the 7th. So they're not going to cut rates, guaranteed. They're not cutting rates. June, this is becoming less and less likely. So it's still a coin flip as far as I'm concerned. Given the duration between now and the 18th of June, it's a coin flip. This is a very volatile number. It's July that looks highly probable that we're going to get a rate cut. If anything, this is stabilized where this is, again, a bit of a coin flip for June. So what may we expect? What could cause the equity markets to rally between now and July due to the Federal Reserve? Look no further than the Federal Reserve's balance sheet, which has stopped going down. I've warned about this for weeks now. Don't expect a rate cut anytime soon. If anything, expect a reduction in the sale of bonds off of the Federal Reserve's balance sheet. That will allow for bond yields to either stabilize or go down. Take a look at bond yields this week. They are dropping like a rock because one of the sellers out there, the Federal Reserve, isn't selling. So, if anything, you're seeing a flattening out with a bias to the upside. Once we begin to see us take out prior highs, let's call it the week of March the 19th at $6,756 billion on the Federal Reserve's balance sheet, that's a new uptrend. So we've gone from lower highs and lower lows to now putting in higher lows and higher highs. Guess what equities are going to do? They're going to go up because that's a quasi rate cut. They just don't want to talk about it because they haven't gotten a firm grip on inflation. That's why they don't want to talk about cutting rates. And the employment picture still looks okay. Okay, let's talk about the monthly charts. Talon, the man, the mission. I knew it was too quiet here. Let's talk about the monthly charts. So we have a couple of trading days left to go in the month. And it's really critical for us at this juncture to take a pause and say, okay, we have been through a lot this month. The volatility has been off the charts. And the question is, how are we closing out the month? Because it doesn't matter where you trade intra-period. If you're a day trader, it doesn't matter where you're trading on a 1 minute chart. What matters is where you're trading on a 5 minute chart, 15-minute chart. Where's the trend going? And as swing traders, we care about, and as investors, we care about how the monthly chart is setting up because that could dictate where the markets are going to go over the course of the next quarter, the next year, or 2 years. So it's really important. So when we take a look, beginning with the yield curve, which was telling us, screaming at us, that we had a major, major problem, and we still do. We are still in the red zone, the danger zone on the yield curve, but we're well off the highs of the month, measurably off the highs of the month. We hit the upper band of this trading range. Now, unlike prior times where we've seen bonds break out relative to the S&P 500 here, where it rolls over, and it did on the month, bonds this time around did not outperform. Actually, I'm sorry. They did outperform the S&P 500. However, they weren't a flight to safety. I mean, I'll bet you that the XLS, that's the Staples. Let's go to take note of this failure to break out. I'm going to swap out oil, which is always a little bit wonky anyway. Sometimes it breaks out, sometimes it doesn't when you get a steepening of the yield curve. XL, is it XLS? XLP. Oh, it's XLP. XLP. Above. Let's swap out oil for the XLP. Now look at staples relative to bonds. Look at staples. I mean, that's the place to have been. They really rallied strong here in the face of a yield curve which was steepening. So we've noticed this and we've spoken about it quite a bit, in that it looked as though rather than going into the TLT, the traders were worried about the tariff talks. They were worried about the debt and the basically repatriation of capital out of the United States back home or into other markets. So where did money flow? Didn't go into bonds. It went into staples. They pay a yield, plus you have upside appreciation. That was the proxy for the bond market, and it vastly outperformed everything. Now, right now, it's probably underperforming a bit, but if we begin to see the wheels come off yet again, you're probably going to see money flows into the staples, and the XLP is the ETF that you want to look at. Now, Bitcoin, really a bit of a shocker here. And I think that it finally came into its own, because the correlation between stocks here, Bitcoin and S&P 500, highly correlated, around at current 89% highly correlated. Now, one thing that's changed, though, is that if you take a look at a daily view of Bitcoin, the correlation back here in February went negative. Here was only 50%. Here, it was only 16%. Only a few days ago, the correlation was about 0.26%. Bitcoin has been outperforming the S&P 500. Normally, it trades as a risk asset. So how is Bitcoin looking on a monthly time frame? It's looking awesome. Let's take our crayon out. And there you have it. That's a Pimp Mac Daddy bull flag setup. That's a continuation breakout pattern. So the price of Bitcoin on the month is up 14.55%. Think about it. With the S&P 500 down 1.53%. So you can see the changes here in correlation. So they're treating Bitcoin right now as a store of value. And this is something that I have been critical of. It is not the new gold. Gold has vastly outperformed Bitcoin. The however is that Bitcoin has begun to, pardon the pun, shine. And it could be a force to be reckoned with. And I think that the difference here is that now you have ETFs that own Bitcoin, and it's providing stability for Bitcoin. Now, looking at yields on the month, if you could believe it, after all the volatility on yields, we are finally down on the month by nearly 0.75% on the 10-year. That's good stuff. We're seeing lower highs on RSI, lower highs on stochastics, all good stuff. MACD signaling a downtrend. We're still holding on to support here. This is not a broken chart. So this can go in either direction. This is what you call a spinning top formation. Very similar to a doji star formation. There's a tug of war going on between bulls and bears. As a matter of fact, you had a doji star formation the prior month. So that tug of war continues in the bond market with which way they want to take bonds. They don't know. As for the TLT, well, it makes sense. It's been doing nothing for months now. It's been trading sideways, holding on to support, down volume, very, very big on the month. The however is that they've rallied it off the lows of the month. So it's at this point where I bring out my old saying that all down, in this case, months are not made equal. The fact that we traded well off the lows of the month is good. The problem is that we were much higher than where we are right now, and we sold off as well. This is not a bullish chart. Add to that, you have the 50-period moving average on a monthly time frame rapidly approaching the 200-period. Still going to take a few more months to get there, but this is not what you want to see. You want to see these moving averages rising, not flattening out or declining. Right now, you still have the 200-period rising. The 20-period, it's hard to see here, but it's in red, dotted. That is flattened out, but the 50-period is threatening. Treasury inflation protected securities. What does this say about inflation? Well, we're down on the month, fractionally. What this tells me, I have gold overlaid here. Note the correlation. What this tells me is that you have a lot of fear still out there in the markets regarding inflation. The Federal Reserve has not cracked this nut yet. They want to claim victory, but they haven't won. The dollar, clearly the ultimate loser here on the year. And unfortunately, well, it's good that I'm going. I'm leaving for London and Ireland tomorrow. And it's costing a lot more than the last time I was in Europe because of the weakness in the US dollar. Yeah. Down 4.63% on the month. That's a big, big move. Very weak, and it's getting weaker. Good for the emerging market trade. We'll talk about that more later. And good for the Dow Jones, the mega cap stocks, because they export. Volatility on the month. We clearly have given up a lot of real estate here, and we have come back down. We did not take out the highs of August, but clearly momentum is moving up higher. So we're still up on the month by nearly 13%. Lots of topping action here. Could this be the bottom? Yeah, it could be. It could be. For equities, not the bottom for, yes, the bottom for, the top in the VIX, the bottom for equities. I confused myself, which is not hard. Dow Transports, monthly chart. So this was kind of a precursor. It told us what was going to happen. As I always like to say, the Dow Transports are your canary in the coal mine for equities, as go the transports. Usually so goes the equity markets. You have the Dow theory, which is generally tells you that as goes the transports, so goes the Dow. But that goes forward a little bit further where the Dow Jones is still the king of all the indexes out there. And if it goes, in all probability, the rest of the equity markets goes. So the Dow Transports have clearly broken down here. We're down over 8% on the month. We did do some buying here with the railroads. Not much, but we did do some buying. How was volume? This is institutional distribution. This is not mom and pop selling a couple of hundred shares of CSX. This is institutional distribution. So we need to respect it, understand who we're trading against. And if you're buying the transports, you're trading against the big boys here. Dow Jones monthly chart. What would be absolutely incredible is if we close back above this blue line here. If we do, that would mark a recapture and a close back above long-term trend. Now, that would have to be a close within the next couple of days above, let's call it 41,175. That's a big move between now and the end of the month. Could it happen? Sure, nothing's impossible. But I do think that if we do close back down below this support level by the end of business, April, I think what's going to happen here is that we're going to rally into May. We could rally into June. We could rally into July. But what would that mark? It would mark a check back to this prior lower band of support, setting the stage for another move lower. So it's very much like when you get a stock that breaks out, pulls back, does a retest of support, and then follows through to the upside. Flip your monitor upside down. It's the same exact thing here. You rally back. People think that it's safe to go back in the water. Bull market's still going, and all the while, all they're doing is checking it back, and then all of a sudden, the gates of hell open up. So we want to keep an eye on this. Let's not lose sight that we have momentum as measured by RSI and stochastics going the wrong way. Okay? Volume, this is who you're trading against. Again, this is not mom and pop selling 100 shares of ExxonMobil. This is institutional distribution. Michael, did you say you bought CSX? I just threw yes, I did buy CSX. I just threw CSX out there as an example of a stock and the transports that was getting dumped. I could have said Union Pacific or any other transport stock, but I just said CSX. But yeah, I did buy a small position in CSX. Moving on to the S&P 500. Now, S&P 500, same thing here. The however is that we broke down in earnest. We closed down below support last month. This month, we've rallied back, and we could quite see that summertime rally that we see quite often, spring, summer rally, and we do a rally back up and into this upper band of resistance. In fact, what we're going to do when we go over to TrendSpider in a moment, we're going to check out seasonality for the S&P 500, Qs, and IWM, small caps. I'm not going to repeat what I just said about the Dow transports, but it's applicable here. The only difference is that we've already confirmed a breakdown, a confirmation breakdown below trend. So technically, this rally is under a lot of pressure and quite possibly in the rearview mirror. Qs. They also broke down last month and closed there. This month, believe it or not, we have a bullish key reversal on the triple Qs. Now, I did add to our long position of the TQQQ. That is the long ETF, a leverage product, putting you long of the Qs. And that puts us net long of the market, along with Boeing and a couple of other stocks. But they're not huge positions. But this too here, I'm expecting to see a check back to around 520 in the coming months. But is it a melt up? That's the question. IWM. Okay, so we bought more small caps today. They're beaten up. They're cheaper than the S&P 500 stocks, and yields are dropping. The S&P 500 stocks love low yields because they need to go to the bank. They don't have access to the bond market to issue debt. So they need to go to the bank hat in hand and say, I need a loan, please, por favor. And the lower the yield, the more likely they're going to get that loan, and the lower their interest payments, that helps their business. So we added more small caps today purely because you saw bond yields. Let's go to a weekly chart. Not that the week is over. They put in new weekly lower lows, and they broke support last week. And it looks as though we're probably going to get a rollover on momentum. So that's why we added more small caps. Still not a beautiful chart. Big volume on the month. Let's go to the daily chart here. How do we close today? Attempted breakout, declining volume. So I'm okay with nibbling here. I would not get aggressive with the small caps yet. The banks on the month, they're up. Not much volatility with the banks. I think what the banks are pricing in is deregulation. So people haven't wanted to sell the banks. So the banks look okay here. Oh, this is a daily chart. Here. So we're well off the lows of the month. We held support. We held the rising 20-period moving average. I think the banks look okay, even though we're down on the month by over 3.25%. But man, these stocks are ugly. I would keep a stop on XLF right below here. I'm going to draw the line here. 46.79 on the XLF. It breaks that support level, I would be out. But right now, it looks okay. Semis. What a volatile month. Only down now 0.39% on the month. From last month's close to the lows, we were down about 19%. Now we're down only 0.39%. So with this bottoming tail, and this applies to any one of these charts, is telling you is that there is strong support below. Now, if we ever break the support level on this or any other chart, then some real selling begins to ramp up yet again. But right now, looking pretty good. LABU, we bought down here. Nobody wanted this thing. They were killing it. We bought it. We're up on it. And I'm very close to selling at least a portion of the position. Let's go to the daily chart. Not that one. LABU daily. Because we're nearing the prior support level, which broke back here on the 31st of March. So that's going to act as resistance. So we bought down here. We're going to sell up here. And if we close above support and we trade there for a couple of days, we'll buy it back. But right now, I'm going to view this as a wall of cement because we know there's going to be sellers up there. So I'm just going to sell into that strength once we get up there. Could be as soon as tomorrow. Energy, not a good month. We're off the lows. We're still, to be fair, let's do this. Let's get our crayon out. $80 is very good support here. $81 per share is very good support on the XLE. They're not going to close this positive. The best that you could hope for next month is a gap up on the energy stocks and an inside month next month, setting the stage for a continuation move up higher. Michael, if you're requesting chart requests, you got to put them in the forum. You know the deal, dude. You know the deal. You've been here long enough. Put them in the forum, please. Staples. They're down on the month, but they've dramatically outperformed the markets in general. Exception to the Qs now. Volume, good. Discretionary names, now positive. Wow. When the tariff talks began, Tesla was tanking, Amazon was tanking, and XLY was tanking. The reason why XLY was tanking is that Amazon makes up 20% of this ETF. Tesla makes up 12%. And wow, what a comeback here. Quite amazing. Emerging markets. Let's talk about EEM. I don't want to use a leverage product. EEM. I think it's time to look at emerging markets, given the fact that the US dollar is so weak. And in fact, let's get our crayon out here. I think this is a buy all day long. Incrementally. I don't mean all at once. Incrementally. We do own an ETF ex-China, meaning it has no position in China. Most of these emerging market funds have 30% China. I prefer not to have that exposure. So I use EM, I think it's EMXC. And that's up nearly 2% on the month. Bullish key reversal bar. This is clearly the better play. So we will be at, look at this. This is a beautiful chart. Really nice chart on EMXC. No China exposure. Good stuff. Oil. Oil on the month, completely hammered. We're down off the lows of the month, but still down 13%. And this could quite possibly move lower. Gold. Up nearly 7%. We own gold. RSI monthly time frame, 85.64. For context, what we want to do is we want to go back and get as much data here as possible. We'll go back 75 years. Do we get that much data? No, we don't. But we don't need that much data, really. Let's go back. Back to 1974. RSI, this is during the heyday of inflation, hit RSI 90.70. At current, we have RSI 85.64. So there's still room to run, but we're nearing the upper range of where gold is traded historically. So believe it or not, there may be a time where we need to ring the bell on gold. The only caveat to that is if I'm right, and if they do begin increasing their balance sheet, again, meaning the Federal Reserve, and they begin to cut rates, that means that in all probability, gold is going to continue up higher. It may have right now, gold is in a secular bull market, but that does not mean that you cannot have a cyclical bear market within the confines of that big bull market. Much as what you saw here. This is a big bull market here that we're in. We've been in one for quite some time, But within the confines of this bull market, we had this bear market. Now, as for the gold mining stocks, they have been doing phenomenal. The junior miners, they are up over 7.5% on the month. We've been bullish on these for a very long time now, very long time. GDX, these are the senior miners. They're a little bit frothy, trading into the third standard deviation Bollinger Band, up 7.5%. Good volume. These can still move up higher, but start to think about, legging out of positions if you're overweight. I mean, if you've been in this as long as we have, this takes up this. It should be taking up a bigger position, a bigger size of your portfolio. So think about your portfolio allocation, and if you should, book a little bit of profits here and put them elsewhere. There's other areas that are looking really good. Emerging markets looking really good. And let's take a look at silver. This is a leveraged product. Let's go to SLV. Silver on the month down over 2.5%, but we're off the lows of the month. That was one volatile month. We took out the lows of 3 months, the 3 prior months. An amazing check back here. So even if we closed down 2.5%, to me, this is a bullish month. The fact that we rallied back so far. Another area you may want to look at, especially now with the blackouts in Spain, Portugal, parts of France, I think even a part of Belgium as well, uranium. Bullish key reversal. I'm not selling, but I'm not buying anymore right now. I'm going to let the position ride right now, and I own the physical. It's not going to be easy for me to sell the gold. So I could sell the gold mining stocks, but selling the gold is going to be a little bit more difficult. Okay, and that's it for the monthly charts. Let's take a look at our chart requests. Folks, we're going to be using our friends over TrendSpider to help us out with seasonality as well as our chart requests. If you're not using the product, folks, please take advantage of them. Back test your strategies. Great charting, scanning. I use them all the time. I did a video last week on it, live stream. They have AI, predictive modeling, automated trades, custom studies. I mean, it's just so much here. I can't go over it in one shot. I call it the Bloomberg terminal for the average investor, but at a fraction of the cost. Insider buying, unusual options activity, et cetera, et cetera. So much. Use the link below on YouTube, link above on Twitter. If you're not using it, I'm telling you right now, I see the type of sales that they make. Your competition is using them. If you're not using them, you're trading with an arm behind your back. I'm telling you right now. So that's TrendSpider. That's my pitch. Get the 35% discount code, bare minimum 35%. Use that link below on YouTube, link above on Twitter. What charts do we have tonight? Sean with ATOM. Talon, NTB. PM for Franklin. Did I miss anybody? Just 3. That's it. Okay. Let's do it. I want to go over seasonality first of the S&P 500. Now, seasonally, April, we're up over the past 32 years, 73% of the times, 72% of the times in May. I still think that we move up higher here. June is a coin flip. July and August, generally up months. Then comes September. You never know what's going to happen in September and October for that matter. Let's check out the Qs. Generally up only 58% of the time in May and June. July, the better month. August, September, rocky. IWM. May up 67% of the time. June, 60%. Then you trail off into September, and then the back half of the year. 80% of the time, it's up over the past 25 years. IWM in the month of November. Cool. Do we get more requests? FL and OGN. Okay. All right. Let's do okay. There we go. ATOM. All right. So initially, here's my knee-jerk reaction was that here you have what appears to be a dead cat bounce. The however is that let's take these trend lines off and bring up the auto fibs. So this may be stabilizing somewhat at this retracement level. I'm okay with buying it here, but you really need to use a stop loss, right below this support level, wherever you decide. Me, I would put it right down below the lows of the week of April the 21st, and that would take me out at a reasonable stop price. Let's go to the daily chart. No support and or resistance below here to speak of. It's kind of like in no man's land. The only guiding force that you have are those Fibonacci retracement levels right there. There's really not much to guide you here. So I think the macro way of looking at this is that you have a downtrend. Yeah, let's get rid of all these. That is still somewhat clear and defined. We did have a breakout last week, so that's a positive, but I could see here that you're going to have resistance right at about $4.51. You get through there, I'd become a lot more optimistic about the stock. Right now, you're kind of in no man's land. You want to see a recapture of support, and that'll bring the buyers in. How was volume? There's been no volume here. Stokes are hooking up. That's a good thing. So I'm indifferent to it. I think that there's better opportunities out there. I know you've been watching this one for a while. You're into it, but I would just be real careful here. Real deliberate. $4.51. That would be my buy point if we close above it. NTB. Bank of NT Butterfield and Son Limited. What a great name. I'd rather see Bank of Butterfield and Son. But okay, it's still a great name. Good looking chart too. Let's go to the monthly chart. Ah, this is gorgeous. There's your automated trend lines. Tell me they didn't call this one, huh? Click of a button. I've never looked at this chart before in my life. Beautiful breakout. Follow through. Bullish reversal on the month. You're going to have some overhead supply. Right at around 41 bucks a share. We close above it. It's a buy. It's going up. Weekly view. A weekly chart, you're going to have more overhead supply up here. I'm still bullish on it. This is just going to act as a rising ceiling on the stock. So I think that there's still upside to be had here. I love the consolidation. In fact, do we have a Bollinger Band squeeze setting up? Let's bring up our Keltner channels. Let's take the trend lines off. Yeah. Here's your Bollinger Band squeeze. Bollinger Band's trading inside the Keltner channels. This thing's firing off. Bullish. What can I say? It's bullish. Daily chart. Good day today. Nice breakout day. Reasonable volume. Good stuff. Bullish on NTB. PM. Philip Morris. This is one of the OGs of the staples sector, and look at this monster go. It's a buy. Granted, it's extended, but it still wants to go up. Look at the volume. The value of the automated trend lines. Here. You're going to have resistance right up here, 175.64 on Philip Morris. I would think about selling calls with a strike right above that resistance level if you don't want to sell your stock. That's what I would do here. I would sell calls out of the money because this is probably going to act as your rising upper band of resistance. The question you should be asking me right now is, how do I know? How do I know that? By looking at this chart. Simple. History. Because this upper band of resistance was resistance back here, and it was resistance back here. So in all likelihood, it's going to be resistance yet again. So I would think about selling calls on PM. But I do think it's going to go up higher. FL. Foot Locker, it's going lower. It's probably coming down to these support levels. Again, I didn't draw these. This is the AI that's doing it. Right down here. If you're looking for a buy point, you're gonna need to buy it at a 4 handle. I know that's a big statement or bold statement, but I know the stock is trading at about 13. It's going lower. We broke real serious quarterly support. You're down on heavy volume. We're doing a check back week thus far. If we close above $14.15, maybe you get a rally here. If we fail to close above it, we probably fade and we head back down into a death spiral on Foot Locker. I'm not a buyer here. I think it goes lower longer term. OGN. The one thing I would say about Foot Locker is you should look at the short interest because that's probably heavily shorted. So you may have a short squeeze trade there if you want to play it bullish. But again, you got to wait. You got to wait for a close above 14.10 per share. Last chart up for tonight. Hey, Sean, thank you very much, my friend. Appreciate it. Thank you very much. OGN, Oregon and Company. It's in a downtrend. Yeah, I don't even need the automated trend lines here. I could draw you even more defined ones. I would avoid right now. I would revisit it on a close above $15 per share. Till then, we're making lower highs and lower lows. There's no reason to be involved with this to the long side. Plenty of other better opportunities to get long of right now rather than worrying about a stock in a downtrend. That's just hoping when you should fear. So that's my take. All right, folks, thanks for being here. Don't forget about TrendSpider. Get that bare minimum 35% discount code. Use the link below. YouTube, link above Twitter. And like, subscribe. You know the deal. Everybody have a profitable trading week. I'll talk to you soon. Be well. And members, I will talk to you from London. Be well.